Although SPACs have been around since the early 1990s, they have gained significant popularity in recent years. In 2020, top personalities such as former NBA star Shaquille O'Neal, former politician Paul Ryan, and hedge fund billionaire Bill Ackman were looking to create their own SPACs. In this video, we discuss what a SPAC is, how it works, and why they have been under the spotlight in recent years. So what is a SPAC? SPAC stands for Special Purpose Acquisition Company, which is a shell company that is publicly listed on a stock exchange but has no real operations. Instead, it holds a large pile of cash that it has raised from various investors. A SPAC's sole purpose is to use this cash to find a private company, buy it, and take it public on a stock exchange. So what does going public mean for a company? When a company is private, this means that only select investors and employees can buy shares in the company. For context, shares represent units of ownership in the company. However, when a company goes public, anyone in the general public can buy the company's shares. In the stock market, a successful SPAC moves through the following three stages. The first stage is when the SPAC completes its IPO, where it raises capital from investors at $10 per unit. At this stage, the SPAC is just a shell company and holds nothing but cash that it has raised from investors and continues to trade close to its original $10 price in the stock market. The second stage begins when the deal to merge with a private company is announced. Depending on the growth prospects of the company and how it is perceived by investors, the share price of the SPAC can move higher or lower in the days that follow. The third stage begins once the merger is completed and the SPAC is no longer a shell company, but instead a newly formed public company. This is when the shares of the company begin trading on a stock exchange just like any other public company. Since the previously private company gets the SPAC's place on the stock exchange, the name of the stock and ticker symbol change to reflect the name of the newly formed public company. SPACs typically have 24 months to complete a merger, otherwise they have to return the cash that they raised from their investors if they are unable to find a target company to buy. Since there is no basis for valuation, SPAC offerings are initially sold for $10 per unit, where each unit can comprise of both shares and warrants that the investor can exercise to purchase more shares at a discounted price in the future. So why SPACs? The traditional path to going public for a company is through an initial public offering or IPO. This is when a private company works with investment banks to navigate a lengthy process spanning 12 to 16 months, where they seek to raise capital from institutional investors, after which the company shares are made available for trading by the general public. Consequently, IPOs can divert valuable time and resources away from the operations of the business. IPO regulations are also quite strict, which disallow the private company from promoting the sale of its shares to potential investors before the IPO is completed. Alternatively, a SPAC enables a private company to bypass the traditional IPO route of going public with a more accelerated and less regulated process, which is known as a reverse merger. Once the merger between the SPAC and the private company is completed, investors who had previously purchased shares in the SPAC now own shares in the newly created public company. SPACs are also called blank check companies because investors that put money into the SPAC don't know which company they will end up investing in. The managers of the SPAC are responsible for finding and merging with the right company that they believe has strong growth potential. Although investors do have the right to approve or reject a proposed merger, most investors rely on the judgment and expertise of the SPAC's managers to find the best private company to invest in and typically vote in favor of the merger. In fact, SPAC investors largely base their investment on the track record of the SPAC's managers. SPACs are run by industry specialists, entrepreneurs, and former executives who have the knowledge and experience to help accelerate the growth of the business that merges with the SPAC and becomes a publicly traded company. A huge advantage for companies going public through a SPAC is that it enables private companies to provide deeper insights about their current and expected future performance to potential investors, which can generate greater interest from investors and corporate stakeholders. Critics warn investors that the SPAC model is quite risky because they never really know what kind of company their money will end up being invested in. Private companies that are purchased by SPACs will often provide highly ambitious forecasts about their future performance to garner greater interest from investors. Additionally, due diligence conducted on SPAC deals is not as rigorous and regulations are relatively looser than traditional IPOs. This opens up room for manipulation and fraud, which potentially increases the risk of investors losing their money. Despite these risks, SPACs have become increasingly popular in recent years. So why is this the case? Prior to the inception of SPACs in the 1990s, there was a similar investment vehicle that existed in the 1980s called a blind pool. Blind pools had questionable practices and were linked to several penny stock scandals that defrauded many investors of the capital that they had invested. This is why SPACs also had a shady reputation for many years. However, new laws and regulations introduced since the late 90s have boosted investor confidence and have led to growing acceptance of this investment vehicle by both institutional investors and the general public. Additionally, the COVID-19 pandemic introduced extreme volatility into the market, which adversely impacted the valuations of public companies. Why does this matter if a company is looking to go public through an IPO or a SPAC? Because with a SPAC, there is a greater degree of certainty that a private company will be able to go public compared to an IPO, which can be difficult to execute during periods of market volatility. This is because an IPO involves complex negotiations over an extended period of time with a variety of different investors who make the IPO fundraising process possible, where key terms about the fundraise are not finalized until the later stages of the process. When markets are volatile, investors and management teams can get spooked and withdraw from the negotiations entirely, resulting in a huge waste of time and resources. On the other hand, SPAC deals are a simpler, shorter negotiation process between the SPAC itself and the target company where key terms are finalized much earlier in the process, which increases the chances of the deal being completed at a more definitive valuation. As a result, several high-profile SPAC deals have been completed in recent years. These include Richard Branson's space exploration firm, Virgin Galactic, which went public through a SPAC in 2019, and sports betting firm DraftKings, who did the same in 2020. If you enjoyed this video, please like and subscribe to our channel. If you're interested in pursuing careers in finance, check out the link to our training program in the description below. Our program includes dedicated interview prep, mentorship by current industry professionals, and direct career placement opportunities in finance. Thanks for watching, and we will see you in the next video.